Welcome back. We are with another class of Unit 2 in continuation, that is money and banking. And in this, we are going to do commercial banks. So, what are the two important functions of a commercial bank? That is, it accepts deposits and it lends. So, those are, and it has public dealings. It has dealings, it's an intermediary between the savers and the investors and the borrowers, if you call them. So and then it creates credit. So how can we say that bank is different from, say, a post office saving bank? Is it the same? No, because the post offices don't lend. So if I talk about, say, life insurance corporations, are they? Let's find out. Let's go through this. You must answer these questions which I've written. So again, let me just so commercial banks. So people keep their surplus money in banks, and banks give loans to the needy based on this. So banks are important institutions in any modern society because they act as intermediaries between savers and borrowers. And another important thing is they create money, which we will be doing later on in the next class. So, commercial bank is a financial institution which accepts deposits from the public and gives loans for the purpose of consumption and investment. So, we've had this Banking Companies Act of 1949, and in that it says a banking company is one which transact the business of banking, which means the accepting for the purpose of lending or investment of deposits of money from the public, repayable on demand or otherwise, and withdrawable by check, draft or otherwise. So based on this, we have two very important functions of the commercial banks, that is acceptance of demand deposit that have check facilities, and then it is lending. So acceptance of checkable deposit is necessary, but it's not a sufficient condition for a financial institution to become a commercial bank, because both have to be there, both the conditions. Now, for example, I pose the question, just take post office savings. They are not post office savings bank. They are not banks, even though they accept checkable deposits from the public. This is because they do not perform the function of lending. So, in other words, they do not create demand deposits which are a part of money supply. Similarly, lending alone does not make any financial institution a bank. For example, financial institutions like, say, Life Insurance Corporation of India give loan, but they do not accept checkable deposits from the public. So these financial institutions also do not create money and hence cannot be called banks. Now, based on all what we've done, we can divide into two parts. That is functions of commercial banks, that is accepting deposits, that is demand deposits, fixed deposits, which are fixed deposits also known as time deposits, and saving account deposits. So what are demand deposits? They are also known as current account deposits, are those deposits which are repayable by banks on demand. And these are checkable deposits. They can be withdrawn any number of times. No interest is paid on such deposits. These deposits are made by businessmen to carry out their day-to-day transactions. Banks offer overdraft facilities on current account. Now, what are fixed deposits or time deposits? These are those which can be withdrawn only after the expiry of a certain fixed period, say a few months or a few years. Fixed deposits are maintained both by firms and households. The rate of interest offered on such deposit depend on the time period. The longer the time period, higher will be the interest rate. And of course, no check facilities is available on these deposits. Then we have saving account deposits. Now, saving account deposits have the feature of both demand deposits and saving deposits. Check facility is provided to the depositors, but some restrictions are imposed on number and amount of withdrawals. Hence, banks offer interest on these amounts, but less than that on fixed deposits. Now, another part is advancing loans. So giving loans is another important primary function of commercial banks. They advance loans and earn interest income. The rate of interest at which they give loans is known as lending rate. Banks give loans mostly for productive purposes against collateral or securities. The amount of loan is generally less than the value of the security offered. So the types of loans that the bank offers, let's see. First is cash credit, second is demand loans, and third is short-term loans. Let's take the first one, cash credit. Under this loan, a credit limit is sanctioned by the banks. The borrower may withdraw any amount within the sanctioned limit. The borrower is charged interest only on the amount of money that has been actually drawn and not on the amount that has been sanctioned. Now, demand loans. Demand loan refers to those loans which can be recalled on demand by the bank at any time. The entire sum of demand loan is credited to the borrower's account and interest is payable on the entire amount. Now, what are short-term loans? They are given as personal loans against some collateral security. The money is credited to the amount of the borrower and the borrower can withdraw money from the account and interest is payable on the entire amount of the loan granted. So in the next class, we are going to do how is credit created or money created by the commercial banks.